Good morning, everyone. Welcome to the market opening bell on Tuesday, December 9th, your 10-minute guide to the stock market. The market is watching the U.S. Federal Reserve's interest rate decision this week with a 25 basis point rate cut widely expected. China's November export data beat expectations, yet Hong Kong stocks remained soft. The Hang Seng Index opened 17 points lower, traded choppily lower throughout the day and breached the 26,000 level. Near the close, it fell as much as 330 points to an intraday low of 25,755. It ended the day at 25,765, down 319 points or 1.2%, snapping a two-day winning streak. The X-share index fell 114 points or 1.3% to 9,083. The Hang Seng Tech Index closed flat at 5,662. Total market turnover was 206.2 billion Hong Kong dollars. Southbound stock Connect recorded a net inflow of $1.54 billion into Hong Kong stocks. Among the major flows, net buying was seen in Xiaomi, totaling $1.173 billion, SMIC $466 million, PopMart $432 million, Agricultural Bank of China $291 million, and Meituan $122 million. Net selling focused on Tencent, totaling $762 million, Hua Hong Semiconductor $208 million, China Ping An $180 million, and Alibaba $103 million. Notably, southbound funds have bought Meituan for 8 consecutive days, total $3.018 billion. Xiaomi for 7 straight days, total $6.238 billion, while selling Tencent for 5 straight days, total $4.667 billion, and Alibaba for 3 straight days, total $1.88 billion. Technically, the Hang Seng Index closed slightly below its 100-day moving average at 25,833, but whether this is a genuine breakdown or a false one remains to be seen. Another key support level to watch is 25,650. Mainland Chinese stocks performed well. The Shanghai Composite closed at 3,924, up 21 points or 0.5%. The Shenzhen Component Index rose 182 points or 1.4% to 13,329, while the Chinex Index surged 80 points or 2.6% to 3,190. The renminbi central parity rate against the US dollar was lowered by 15 pips to 7.0764. China's Customs Administration reported that November exports grew 5.9% year-on-year, reversing October's 1.1% decline and beating analysts' forecast of 3.8% growth. The improvement was partly due to the tariff truce between the US and China. Imports, however, rose only a mild 1.9%, below the expected 3%, reflecting persistently weak domestic demand. The larger than expected trade surplus provides some cushion for recent economic growth, though weak imports highlight ongoing challenges in consumption and investment. On the Hong Kong market, Chinese insurance stocks bucked the trend and rose. China's National Finance Regulatory Administration issued a notice adjusting risk factors for certain insurance company businesses, offering a 10% discount on CSI 300 Star Market and other qualified equity exposures. This move may ease capital requirements for insurers, encourage them to act as long-term stock market investors, and benefit the equity market overall, as insurers are major players. More insurance capital is expected to flow into stocks next year. Chinese brokerage stocks also rose against the trend. At the China Securities Association conference in Beijing, CSRC Chairman Wu Qing said regulators will strengthen classified supervision, support the strong and restrict the weak, appropriately relax rules for high-quality institutions, optimize risk control indicators, ease capital and leverage restrictions, and improve capital efficiency. For small to medium and foreign brokerages, differentiated regulation will be explored in areas such as classification ratings and business access to promote specialized development. Problematic firms and illegal activities will face strict penalties. In the auto sector, data from the China Passenger Car Association showed November retail passenger vehicle sales of 2.225 million units, down 8.1% year-on-year. and 1.1% month-on-month. Cumulative sales for the first 11 months reached 21.483 million units, up 6.1% year-on-year. November new energy passenger vehicle retail sales were 1.321 million units, up 4.2% year-on-year and 3% month-on-month. Cumulative NEV sales for the first 11 months were 11.472 million units, up 19.6% year-on-year. The NEV wholesale penetration rate in November reached 56.9%, 8 percentage points higher than a year ago. Domestic brands achieved 72.2% NEV penetration, luxury brands 42.8%, while mainstream joint venture brands lagged at just 7.5%. The association noted that strong trade-in subsidies are expected to exceed 180 billion yuan in 2025, combined with a 10% purchase tax exemption for NEVs, adding over 22% more benefited sales than in 2024, meaning more than 200 billion yuan in vehicle purchase tax will be waived on over 2 trillion yuan in NEV sales. With nearly 400 billion yuan in tax exemptions and subsidies, the auto market in 2025 is expected to grow beyond expectations. However, when NEV purchase tax relief is halved in 2026, reducing benefits by over 100 billion yuan, growth pressure will surge dramatically. At the 2025 Innovative Drug High Quality Development Conference held in Guangzhou on Sunday, the latest National Reimbursement Drug List (NRDL) for basic medical, maternity, and work-related injury insurance was released, the eighth adjustment since the establishment of the National Healthcare Security Administration. The list added 114 new drugs, of which 50 are Class 1 innovative drugs, with an overall success rate of 88%. The first commercial health insurance innovative drug list was also officially released, with 19 drugs from 18 companies, including Eli Lilly, Pfizer, Luye Pharma, and Beijing, successfully included. 9 of them Class 1 innovative drugs, covering oncology, rare diseases, and chronic illnesses. After this adjustment, the 2025 NRDL will contain 3,253 drugs in total. Coverage for oncology, chronic diseases, mental health, rare diseases, and pediatric drugs has been significantly enhanced. Ahead of the Fed meeting, U.S. stocks fell. The VIX Fear Index rose 1.25 points or 8.1% to 16.66. The Dow closed down 215 points or 0.45% at 47,739 after being down nearly 300 points intraday. The S&P 500 fell 23 points or 0.35% to 6,846. The Nasdaq dropped 32 points or 0.1% to 23,545. The Nasdaq Golden Dragon China Index, checking Chinese ADRs, edged up 6 points or 0.08% to 7,837. Netflix shares fell 3.4% after President Trump hinted that a potential acquisition of Warner Brothers assets could trigger antitrust concerns. Paramount Skydance reportedly plans a hostile takeover bid for Warner Brothers. Discovery at $108 billion or $30 per share, and has secured up to $54 billion in financing commitments. Paramount shares jumped 9%. Nvidia rose 1% on reports that the U.S. Commerce Department will soon approve exports of its H200 chips to China, a possible sign of easing in U.S.-China trade and tech tensions. Alphabet fell 2.3%. The company said it is developing 2 different types of AI smart glasses, one with a display and one audio-focused, with launches targeted for next year. Tesla dropped 3.4% after Morgan Stanley downgraded the stock from overweight to neutral for the first time in over 2 years. Broadcom rose 2.8% on news that Microsoft is in talks with Broadcom to design future custom chips and may shift business away from Marvell, whose shares plunged nearly 9%. Separately, Marvell has reportedly tried to win more Meta business by waiving some upfront engineering fees for a chip Meta plans to launch in 2027. Oracle gained 1.4% ahead of its earnings release on Wednesday. Confluent soared 29% to $29.87 after reports that IBM plans to acquire the company for $11 billion. Confluent's real-time data streaming platform is expected to strengthen IBM's enterprise software and AI offerings. The deal is expected to close around mid-2026. Our stock pick today is Baidu, stock code 9888. Baidu's third quarter results fully demonstrated the transformative value of AI across its entire business portfolio. The Intelligent Cloud division continued its strong growth trajectory, powered by ever-widening enterprise adoption of Baidu's AI products and solutions. Apollo Go markedly accelerated the large-scale rollout of fully driverless operations and kept pushing its global expansion, including a new presence in Switzerland, all while maintaining the industry's highest safety standards. Within the mobile ecosystem, AI-native commercial offerings such as agents and digital humans delivered rapid revenue growth and revealed impressive long-term potential. Although total revenue declined 7% year-on-year and 5% quarter-on-quarter to 31.174 billion yuan, largely due to macroeconomic pressures and a weak advertising market, revenue from the new AI-related business soared more than 50% year-on-year to around 10 billion yuan, contributing 32% of total revenue. This segment has clearly become Baidu's new growth engine, successfully offsetting the softness in traditional advertising and providing powerful momentum to reshape the company's overall revenue mix. Within the new AI businesses, the AI cloud segment extended the steady growth seen in the first half of the year, rising 33% year-on-year to 4.2 billion yuan. Explosive enterprise demand for AI infrastructure, especially data centers and model training services, drove subscription revenue from high-performance computing facilities up 128%. Baidu Cloud continues to gain market share and has firmly established itself as the undisputed leader in China's AI cloud market. AI-native marketing services generated 2.8 billion yuan, an astonishing 262% higher than a year earlier. By harnessing the ERNIE large model to optimize ad placement and content creation, this business significantly boosts advertisers' return on investment and has attracted a flood of small and medium-sized enterprise clients. It's now the largest contributor to non-online marketing revenue, underlining how quickly AI is penetrating the advertising space. Most of Baidu's AI applications operate on sticky subscription models that produce high-quality recurring income. Revenue from AI applications rose 6% year-on-year to approximately 2.6 billion yuan, covering areas such as intelligent assistance and content generation. ERNIE bots monthly active users have now surpassed 500 million, and its monetization efficiency has improved by more than 20%. On the intelligent driving front, Apollo Go completed 3.1 million fully driverless ride-hailing orders in the third quarter, with year-on-year growth accelerating from 148% in the previous quarter to 212%. In October 2025 alone, the service averaged more than 250,000 fully driverless orders per week. By November 2025, Apollo Go had provided over 17 million autonomous ride-hailing trips to the public in total and was operating in 20 cities worldwide. In mainland China, it has already achieved 100% fully driverless operations in every city it serves, including Beijing, Shanghai, Shenzhen, Wuhan, Chengdu, Chongqing, Haikou, and Sanya. The fleet has now accumulated 240 million autonomous kilometers, of which 140 million were driven completely without a human driver, while maintaining an exemplary safety record. Investment suggestion buy around $122. First target $132. Stretch target $135. Stop loss $115. I do not currently hold the stock.